Welcome to Money Answers TV. I'm your host, Jordan Goodman of MoneyAnswers.com. Today we're going to find out more about ways you can pay your mortgage off years sooner than you ever thought possible using the strategy of equity optimization. My guest is Bill Westrom, Chief Executive Officer of TruthAndEquity.com. Bill, welcome to Money Answers TV.
Hi, Jordan. Good seeing you again.
So please explain how the current financial system in which people keep their money in checking accounts and pay on a mortgage for 15 or 30 years works well in the interest of the bank, but not really for consumers.
Well, the conventional financial system I refer to as the conventional model of banking and borrowing, how we actually run our finances on a day-to-day basis. And that conventional model is designed to maximize the profitability of the bank. They make money on every financial move we make. Our deposits, they're making money. The interest we pay on our mortgages, they're making money. So the whole thing is so imbalanced that when we bring in the equity optimization strategy, it turns it 180 degrees in the opposite direction. So the consumer is now operating like a bank versus a consumer the way they want you to operate. You operate like they do, you reap the rewards, just like they do.
So what are the benefits of implementing an equity optimization strategy for the typical consumer?
Well, the benefits, you kind of have to look at it almost like an investment on the asset side, right? There's short and long-term benefits. With equity optimization, short term, you're saving interest on every dollar you earn from the day you start the strategy. Over a long-term standpoint, you could save tens to hundreds of thousands of dollars in interest compared to what you're paying right now under the conventional model.
What financial criteria does someone who wants to do equity optimization need to make it successful?
Well, the most important thing we're looking at right from the beginning is lendability. We need a decent to good credit score so we can go to the conventional banks to get the loan that we need to get the strategy started. You need positive cash flow, fiscal responsibility. You can't be living beyond your means to make the strategy work. When we're looking for a home equity line of credit, we need home equity. But I work with a lot of customers that don't have equity in their homes, and we can start with an alternative line of credit, being a personal unsecured line of credit, to do the same thing.
Some people say they don't want to pay their mortgage off fast because they're not going to get mortgage interest deductions. What do you say to those people?
I have lots of those conversations, especially with the new tax laws. But when you look at the deductibility of mortgage interest, right, you don't get to write off 100% of the interest. You're only writing off a portion of it based on your tax bracket. So people are losing 70 to 75% of that interest to the bank and only capture 25 to 30% on their tax return. So the whole mortgage interest thing, there's not a lot of benefit to it because you're losing so much money to save very little.
How does paying your mortgage down faster help you with other major expenses like buying a car or financing college, something like that?
Well, that's a beautiful thing about this strategy, because every dollar of principal that you pay back accumulates in the line of credit for later use. So I've got hundreds of customers that are paying back student loan debt, they're paying back consumer credit card debt, they're buying cars or paying off cars. So there's really nothing you can't accomplish financially with this strategy, because every dollar you pay into it accumulates in the available funds column for later use for any other financial need that you have.
Some of my viewers may be skeptical that equity optimization could work for them because they've never heard about it from bankers or financial advisors. What do you say to people who are worried this may not work in their circumstances because of what they may have heard from their financial advisors?
I get that a lot, because a lot of people rely on their financial advisor for all their financial advice. But what we found is most financial advisors, they're experts on the asset side of the ledger, right? They're not debt experts. And any advice that people generally get from their advisor is just from that advisor's experience or what he's read and heard about lowering your rate or what have you. So we always stress to people that because they're not experts on that debt side, bring a debt expert in, right? Somebody that has that level of expertise in this strategy so we can quantify and qualify results based on their current budget. And I always have people bring in their financial advisor because they're not experts. I have got no problem educating that financial advisor so he can support and or give proper advice to his customer when it is on the debt side of the ledger.
So even if you bring a financial advisor in, people will say, it sounds too good to be true. How do you respond to that?
It's all in the math. I will quantify and qualify everything that I talk to them about because I'm going to work with their budget numbers. And it's money in, money out. It's all third grade math, Jordan. It's no different than the math in their checking account because that's all we're really doing is merging that checking account activity, deposits and withdrawals for expenses, what have you, into a line of credit. And that's where people, they get lost in the whole process understanding this line of credit. The reason a line of credit is used is it has that revolving door. It provides the same liquidity as a checking account. So you can put 100% of your income in and know with 100% certainty you can get 100% of your expenses back out without filling out an application, without anybody's permission. It's got the same liquidity as a checking account. So through the process, I can quantify and qualify everything based on the numbers.
Is this strategy more commonly used in other countries around the world?
In one form or fashion or another. Other countries have realized that paying on a debt for 30 years is just not a wise thing to do. So they've developed other variations of being able to combine those deposits and debt to reduce interest costs and expedite the payoff of that debt.
Do people need to be very disciplined to implement this strategy?
No more than they are right now. That discipline word kind of scares people. And that's why if we go back to fiscal responsibility, just don't live beyond your means, just like you do today. And I tell everybody that becomes a customer, don't become somebody different after you meet me than you were before. Just maintain that fiscally responsible lifestyle. Numbers will work out and you'll achieve the goal.
What are the downsides to using this financial strategy?
It's a good question because people are also scared of the downsides of something they don't know. But what I tell people all the time, you're the biggest downside. And I tell new customers all the time, don't become somebody different after you meet me. If you're fiscally responsible before, just stay that way. On rare occasions, and this occurred back in 08, 09, that the bank can freeze or cap a line. And that's to protect the bank and the consumer. It's not a penalty to anybody, but there are always remedies to unfreeze or uncap the line so the consumer can keep on moving and keep rolling with the goal.
Are there ways of using a similar strategy with a personal line of credit if somebody doesn't own a home or doesn't have equity in their home?
Yes, there is. Because the line of credit is what we're after. That line of credit gives us the revolving door we need. Whether it be home equity or unsecured, it really doesn't matter. And speaking of the 08, 09 debacle, I helped a lot of people continue using the strategy with an unsecured line and again, not slow the process down at all. But it works exactly the same. It's virtually the same animal as a home equity line of credit as the personal line of credit.
What services does Truth and Equity offer people to help them implement this strategy?
Well, we're a soup to nuts company as it relates to implementing and executing this strategy. And we start off with a thorough analysis of the consumer's budget, and we stress test it through a proprietary amortization model to determine suitability. This just doesn't fit for everybody, and we want to make sure we're giving good recommendations. And then from that point, we help them obtain the right line of credit for the job. We teach them how they're going to run their life on a day-to-day, week-to-week basis within the confines of the strategy. But the best part of what we do is a monthly meeting with the consumer to analyze their activity, evaluate their performance, to making sure they're doing everything right and getting the most out of the program.
So why should somebody use Truth and Equity instead of trying to do it themselves?
Well, there's a lot of variables that come into play of getting this done right. Choosing the right line of credit is critical because you can walk into 10 banks, all their lines of credit look the same, but behind the lobby wall, that's when the bank starts dictating what you can and cannot do, and that's critical to how you're going to be operating moving forward. And then on a day-to-day basis, how are they going to live their life? Buying gas, buying groceries, paying for this, paying for that. That's where we customize the program for each individual so they achieve at the highest level and hit the accomplished goal.
Have you had some people try it on their own and then come to you saying, I just can't work this out on my own?
I've had many. And what I've found is that most self-implementers, as we call them, they're going to achieve at 40 to 60% of what this is capable of doing. With our help, our tutelage, and our support, they're achieving at 100%.
What kind of impact have you had on people's lives who've implemented the truth and equity optimization strategy?
That's a big question right there, because everybody's different, and what we've done for people through helping them implement this strategy. What I hear most from anybody, or from most customers, is it's a liberating and freeing experience. Because once you implement this strategy, the walls of the conventional model fall away, and they can do whatever they want to. I've helped real estate investors double their portfolio in 3 years compared to what they were going to do conventionally. So the impact is huge.
If someone wants to see if equity optimization can work for them, where should they go to contact you? And what's the process they go through once they go to your website?
Well, the best place to start is truthinequity.com. And from there, they can fill out a personal profile, which is just their budget as it sits today. What do they owe? What do they spend? And what do they bring home in income? And then definitely have a conversation with us so we can get to know them, they can get to know us, because our agenda is their agenda, and that helps us customize their program. Once their profile is complete, we'll have an online meeting to where we can actually go through the numbers with them month by month and bring tangibility to this whole concept. Most people are visual learners, and when it comes to finances, it really helps them picture in their mind's eye exactly how their life is going to look with equity optimization.
Thanks very much, Bill. You're going to help a lot of people pay off a lot of debt.
Thanks, Jordan.
So if you are interested to learn how to pay your mortgage off years faster than you ever thought possible, look into the equity optimization strategy. For Money Answers TV, I'm Jordan Goodman.